We're about a couple minutes before the top of the hour, so hang on while other folks hop in, but we will get started shortly. Thanks for logging in early, and we'll talk soon as we're ready to go. Hi, everyone. My name's Josh Payne, and I'm here today with Sung Lee. Say hi, Sung.
Hey guys, what's up?
So together we're going to talk about some research that Sung did using data from a CERN. And once Sung and I sort of walk through that research, we'll throw it over, and we've got Kumesh, the CEO of a CERN, and he will give some background on the data that Sung sort of based his research on. So without further ado, why don't I hop in and get things started. Yeah, as folks, so the way this is structured, I'll do a quick introduction on Quantopian data and the data that we're providing on the platform. Then Sung will walk through the research. That'll be the bulk of the presentation. We'll throw it over to Kumesh, and then we'll open it up to Q&A. Hopefully we got some good questions. We'll get some good questions along the way. So Quantopian data is sort of a newer section of the site, newer section of the product. That we introduced last month. So all along on Quantopian, we've provided free access to market data for the entirety of our product, the entirety of the company's life. We've provided market data for free dating back to 2002. So that means we've got data for over 13 years of U.S. equity market data. And that's been free, and that will always be free for use on the site. Last year, I want to say last December, we introduced free access to fundamentals data. So we have over 600 metrics for U.S. companies for all their fundamental metrics from Morningstar. And we do our best to create a point-in-time database. So those two free data sources are free, continue to be free, and you can access those data sources in your algorithms when you're building your strategies in the IDE, and then they're also accessible in Quantopian research. So you can have more ad hoc access to that data to explore it as you're researching your hypotheses. And so all that data is free for use. In addition to that market and fundamental data, we introduced 25 new institutional quality data feeds built into Quantopian last month. So in addition to that sort of table stakes market and fundamental data, now we've got data that you can use to build and look for signals and really build your strategies around. Look for alpha in these data sets. And you could also use them for your risk models as well. So now these are new data sets that you can use to augment or drive your strategies overall. So if we scroll down here a little bit, we can see some of these 25 data sets. We get here on the Quantopian site by clicking on data in the menu. And we've got lots of different data sets from, right now we've got 3 vendors in place. We've got 3 more vendors in the pipeline. So we've got a CERN and their new sentiment data. We've got Estimize and their crowdsourced earnings estimates data. You also get Wall Street consensus numbers in there as well in their data set. And then we also have event data from EventVestor, things like when, answering questions for your algorithm, like when will earnings announcements occur for each of the companies that I'm concerned with, or when did an FDA action, or was there a CEO change, or was there a stock buyback announcement? All sorts of announcements, events that you might want to know about for your algorithm are available from EventVestor. All these data sets, we also provide large chunks of free data for each of these data sets. So a CERN, Estimize, EventVestor, all these data sets, you also have an opportunity to look, explore, build strategies, test your strategies with free data for each of these data sets. The difference with most of these data sets is that free segment is only for a particular time period. Typically, there's a free portion and then a premium portion for each of these data sets. So if we click into a CERN here, in the case of a CERN, the free data goes from the beginning of that data set, and if we scroll down, we can see it. It goes from the beginning of the free data set out to 2 years from today. So there's a trailing 2-year window where the data isn't free. So the last 2 years, not free, but the data prior to the last 2 years, free. So you can try this data out, explore it, use it in research, and make an educated buying decision about it once you decide that it's something that you want to work with. Once you do make that buying decision, there's a subscription fee for on a monthly basis. Each of these vendors is different. If you want to look at a sample, we've got some documentation, but if you want to look at it and get started quickly with a sample, there's that example notebook link there. You can click on it and you'll launch a research notebook, and that IPython environment shows the data in action, shows those free samples in action. So that's the quick introduction to Quantopian data. Happy to answer questions on that, but without further ado, let's start talking about Song's research and the research that he did with a CERN's Alpha 1 data. So Song, thanks for coming today. I was looking over the notebook, and I wanted to start sort of simple for folks. You did an event study, right?
Right.
So can you explain for the audience what exactly is an event study?
Right. So an event study is basically a study around how an event affects a stock's return streams. So for example, if Apple has an earnings announcement on October 1st, an event study would be looking at what does Apple's stock price look at 20 days prior to the earnings announcement, and how does that stock's price change on the day of the event, so October 1st, and then you're looking 20 days afterward to see if there's a pattern, and you extrapolate that to, let's say, all the stocks in the S&P 500 to get kind of a general pattern for how a specific event might impact a security's price during that time.
So an event study is like a way you're looking for signal, right?
You're looking for signal, right? You're looking for not necessarily signal. You're looking for how does this event impact the stock's price, okay, versus what signal is this going to be at this given time. So you're starting with a very general question.
Okay.
When you're first starting off.
So it's a general framework that you can use.
Very, very general.
Okay.
It's it's one of the most common types of research that you can do on any given event.
Okay.
Like there's a ton that have been done on earnings estimates, share buyback announcements, which we have both on Quantopian.
Okay.
But yeah, very, very general.
All right. So what was the specific hypothesis? What was the genesis of this particular research that you did?
Right. So there's this professor named Paul Tetlock who released a paper back in 08-09. It was called More Than Words, Quantifying Language to Measure Firms' Fundamentals. Essentially, the idea behind that paper explored how does the words in a news article affect a stock's price. So specifically, Paul Tetlock was looking at the words in Wall Street Journal articles dating back 30 years ago up till maybe 09. So that's 30 years of data. And what he found was that articles with kind of positive or negative sentiment, or however you want to describe it, articles that were positive had kind of this positive impact on the stock's price, and articles that were negative had a negative impact on the stock's price. So the original hypothesis behind this event study was, okay, this event study, this research has been done on the past 30 years of data, but that was before people had access to the internet. That was before people...
So he's doing like a study on like the Wall Street Journal. People like my dad waking up in the morning, like
getting a cup of Joe,
open up the Wall Street Journal, and then calling his broker that day.
Right. Exactly.
And how does it impact, or sort of using sort of old paper newspaper distribution. So like there's a signal, but that research is probably not really valid
anymore.
because that's the sort of the consumption model that he was
applying to.
Right.
Exactly.
Okay.
Like nowadays, you have your iPhone. You can look at the news and you can trade directly within seconds.
Yep.
Back then, it's like you read the newspaper, you either phone your broker or you get in your car, you run to your brokerage and say, "Hey, I want this trade made."
Yep.
That's like a day or two.
Yeah. So I guess you saw this paper. We talked about this paper in the office, and then what was your hypothesis for this
Right.
work based on this article?
Right. So originally I was looking at, okay, now that everyone has much, actually, so the original hypothesis was Paul Tetlock was only looking at the Wall Street Journal.
Yep.
And Wall Street Journal is a very mainstream source of media. What if we looked at the same type of event study, the same type of research, but we looked at all the media outlets available on the internet? So the idea was that with a greater sample size in terms of the media source, there would be some sort um, of information that's not available to investors that retail investors could trade on.
Sure. So similar hypothesis, but modern world, broader set of news sources.
Exactly.
That are influence behavior. See if we see the same kind of behavior or some different
or
kind
something
of
better.
Right.
The original idea was we find something that's much easier to trade on.
Gotcha.
Right.
Gotcha. So what did you find? Like, walk me through what you executed there in that notebook. What was the finding now that we've established that sort of initial hypothesis?
Right. So the initial hypothesis was, okay, we're gonna find a better way to find alpha. We did, but it was in a much different and very surprising way.
Okay. Tell me more.
Yeah, I will totally tell you more, Josh. We're not gonna go through the code in the notebook itself, but I'll take you guys kind of through the results of it. The notebook is out for anyone attending this webinar, so I encourage you guys to go take a look at yourselves. So the graph that you guys are seeing on the webinar right now is the event study around the release of a negative news article. And so if you look at the graph, and I'll go over what the actual findings were. If you look at the graph, you're seeing that prior to the release of a negative sentiment, there is this gradual decline in the stock's price, starting from 20 days before, and about 2 to 3 days, and even up to a day before, you see kind of this massive spike down in the stock's price. And then after the negative news sentiment is released, you see this upwards gradual drift of about 1%. So you see this post negative news article published drift of about 1% after maybe about a 2% decline in the stock's price prior to.
So that's interesting. So there's a negative news article, and leading into the negative news article,
yep,
the stock's been going down. Once that comes out,
yep,
the stock has a tendency to bounce back. Do we have sort of an underlying
behavioral
hypothesis? Like, why do we think that's behaving that way?
Yeah.
Because this is different than what
this is very different from what Tetlock found. So from what Tetlock found, he saw that this gradual decline. So from Tetlock's research, you would assume that the negative news article was published here, and that after the negative news article, you would see this decline, this steep decline drop. Once again, he was looking at like articles from the 1980s, et cetera, et cetera.
Yep.
Very not readily incorporated into a stock's price. I think actually a lot has changed since that paper came out. So within the past 5 years, you've seen this huge influx of kind of large institutional hedge funds trading off of news data as soon as it comes out. So within milliseconds of information being readily available, you see these funds trading on it and causing this decline in the stock's price that you see right here.
Yeah, okay. Or even in advance, there's some sort of informational imbalance, right?
Right.
There, the news might not be in the public domain yet, but it's in people's hands, and people are starting to trade on it, or it's starting to move the market one way.
Right. So it's people who have, so it's called the asymmetric distribution,
Sure.
asymmetric distribution of information,
Okay.
where some people have access to information that other people don't. It happens. It happens.
So I guess maybe one thing we glossed over, we should step back through is how have we defined this event? Like what is this exact definition of event? How are we, what data are we using? What's the definition of the event on that day 0?
Right. Okay. Yeah. So on day 0, what we're looking at is day 0 is the as of date. So this is when a CERN published their negative news sentiment for any given security.
Okay.
So this is the as of date for the data set that we got from a CERN. So I'm gonna quickly scroll up and show you guys where I got that data.
Sure.
So over here, you're seeing that I'm kind of just importing that from Quantopian.interactive data.cern.
Yep.
And what we're doing is we're saying on the as of date. So if you see here, this is a quick preview of the data. You see, you get the symbol, the name, the as of date, which is when the article sentiment was published.
Where this is actually rolled up on a daily basis.
This is rolled up on a daily basis, but the actual granular level, you would see it by the milli or millisecond timestamp.
Okay, but in this case, in the data that's in Quantopian, this is there's a line for each day for each company that has articles written about it on that particular day.
Exactly.
Okay.
Exactly. And you see the article sentiment, the impact score, the timestamp, which is actually when Quantopian data registered this data.
Yep.
And then the SID. The SID is just a unique identifier for the symbol over here.
So if we walk through this first line, this is there was on August 26, 2012, there were multiple articles written about UPS on that day. The sentiment was pretty negative, right? Negative, essentially negative 0.7, which is, this is on a scale of -1 to 1. So a bad day, bad news about UPS on that day. Somebody must have, missed a bunch of package deliveries.
Yeah.
The impact score, says
lost all the iPhone shipments.
They had a bad day. Best Buy also had a bad day that day, and it was available essentially later that day. Inside the Quantopian environment, or would be in a simulation.
Right.
Got it.
Exactly.
Okay.
Exactly.
Cool. So we say, okay, here's all the negative, the days where companies had negative news written about them. We take that and then we look at their pricing, normalized to
the event, right?
Okay.
So what we're doing, if we go back down here, is we're saying on day 0, which is the as of date we saw in the data, look at each day starting from 20 days ago. Look at the cumulative return relative to t = 0.
Okay.
And calculate the returns of that.
Right.
And then we're doing the same for t + 20. Now, one thing to know is that we're looking at abnormal returns. And for those who don't know what abnormal returns are, they're basically returns you would find over the market.
Okay.
So cumulative returns, when you're just looking at a stock's price, isn't really that interesting, because you could do the same thing by just investing in a low-cost index fund and the SPY, right?
Okay, so we're saying this is like your returns in excess of SPY.
In excess of SPY.
Okay.
Exactly.
Okay, so in this case SPY, but you could choose your whatever
benchmark that
you wanted.
QQQ, NASDAQ 100.
Okay, in this case we chose SPY for because we weren't keeping it restricted to the Fortune 500, but we just used it as a convenience.
It's just a standard benchmark that
Sure.
is very commonly used in the markets. So we're looking at the abnormal returns, and actually what we found was that the information that's incorporated into the stock's price prior to the release of a negative news sentiment actually seems like an overreaction to the negative news.
Okay.
So you see this reversal after the event of about 1%, and this reversal is kind of saying that, oh crap, the information that we traded on isn't that bad.
This is like, my kid's reaction to the prospect of having to eat vegetables at dinner. They dread it. They dread
Exactly.
it. Like there's massive overreaction in the market of my 2 children, and then they actually eat it and they're like, oh, that wasn't so bad.
Right. Exactly.
All right.
The same thing.
So there's a little overreaction in
broccoli is intimidating until you eat it. And it's like, oh my god,
this is pretty good. It's pretty good. All right. So this is just so we've got a broad data. So we got 24,000 events, right?
Yeah.
That we're working with here.
Yeah.
Why negative sentiment? What like did you work through other scenarios
Right.
in your research?
So I chose negative sentiment specifically because in Paul Tetlock's paper, there's a very specific line that stood out to me. It said that negative words in an article had a greater impact on the stock's price. So I just wanted to be in line with the findings on that paper.
Okay, so we wanted to go big, see where the biggest
hit was, right?
Right.
And
Okay.
even with this data, we only looked at events where, so for those, I'll give you a quick primer. A CERN's data also contains an article sentiment score as well as an impact score. So
Yep.
the impact score is what percentage of the time is it going to move by 1% after the news article gets published. We only looked at articles with an impact score greater than 70, just so we absolutely are filtering out noise and getting the biggest bang for a buck that we could.
Got it. Got it.
Study.
So then, I mean, the returns here looks like 1%. We get if you trade on this or in the back test, right? And back tests are, back tests can lie, but if you were to back test it, you could expect essentially a 1% return overall for each of these
on average.
On average for each of these trades. On average, right?
Yeah. So what's the key word, right? On average.
On average. Scroll down here, Sung. Tell me about the standard deviation.
Right. So with any event study, you need to figure out what does the volatility look like around the return streams that you're seeing. So here you're seeing a 1% increase, right, after the event, but what's the standard deviation on that? And that's what we all want to know. And I'm going to scroll down and show you guys that chart over here. So looking at this, it's pretty daunting, right? The standard deviation is actually really high.
Yeah.
But that's actually pretty common in event studies.
Okay.
Any kind of earnings announcement, post-share buyback announcements, CEO change, any event that you're looking at with a large sample size, you're going to get a standard deviation. This is actually pretty good from what I've seen. Like all of the event studies that I've done, this is actually pretty good.
Cool. One last question, and then maybe we'll scroll through the question pane to see if we have any questions before we go over to Kamesh. So if you have questions specifically for Sung, maybe throw some of them in now.
Right.
This is just a starting point, right?
Right.
You didn't go. You're not a quant. Like you're.
Yeah.
Like what?
Like where do you go from here?
Where do you go from here? What's next? What do you think you would want to do next?
Right, and that question kind of goes off of what do you do with this big standard deviation?
Mm-hmm.
So there are a couple ways to go about it. So obviously we've been looking at all the stocks and all the articles in the data set. What you actually want to do if you're using this in your trading strategies is narrow down the exposure and the universe of securities that you're looking at just to whatever that you are actually looking at. You know what I mean? If you're looking at alternative energy ETFs, look at alternative energy.
So you might want to narrow down this is a starting point hypothesis.
Right. Narrow that down as much as you can.
Find some narrower hypothesis, maybe like, the alternative energy, tends to, or some industry tends to be a sort of a punching bag.
It might be an outlier. It might not look like what we've seen above. It might look like something different.
Or maybe you look at Comcast and the cable companies, right? Like they got a lot of bad news articles written about them.
Right.
Maybe go see that. Maybe
negative news articles don't matter to them because
maybe they're immune. Maybe they're immune to it. So maybe you go for the industries where they're the darling, right? Maybe it is the Apples, right? Or the industries that are publicly traded that are sort of more favorably held.
In tune, yeah, exactly.
Yeah, so you could do that as well. You could maybe combine CERN data with industry codes from Morningstar that are built in that fundamental data.
That's exactly what you should be doing. If you're working with this broad of a data set. That's exactly what you should be doing.
Right. So narrow it down. So get a segment of industry. You can get those SIDs, get those equities that are in industry A versus industry B, and then narrow it down. Got it.
Exactly.
Got it.
Another interesting use case, and this is not exactly of the same thread that we've been talking about, is that people use data like this as part of their risk model.
Mm-hmm.
So, for example, if you guys out there on the webinar, if you have a momentum strategy or you have a mean reversion strategy, you're going to get a signal based off of co-integration and some statistical model that you set up.
Total technical analysis.
Total technical analysis, right? But guess what? When you have an earnings announcement that comes out, when you have a negative news article that comes out, that throws off the technical analysis that you just spent 3 hours crunching.
Maybe it's the time you want it.
Or maybe it's the time that you want it.
It depends on your strategy, right? Maybe it's the time you want it. Maybe you don't want that volatility. Maybe there's something about that event that you can use to better inform your strategy.
Exactly, and it's totally dependent on what kind of strategy that you're running.
Yeah, if you're going to something high volatility, maybe you want those.
Maybe you want the negative news. Yeah.
Right. Exactly. Got it. So maybe let's take a quick view at some of these questions, and then we'll Kumesh, you've got the 2 minute warning.
Okay. So how many stocks contribute to the red curve? And that was, so we're just going to run through a couple questions before turning it over to Kumesh. So the first question was asked by Jeff. Jeff asked how many stocks contribute to the red curve. The sample size was, each article was 24,000. I believe, I'm not exactly sure how many unique SIDs there were.
It's it's relatively easy to do that. If you clone the notebook, you could probably figure that out. Just take the Blaze expression that generated, or the Pandas expression that has the 24,000 articles, and then you do like a group by,
or like .unique.
.unique, something like that on it. So don't know. Definitely not 24,000 separate companies, because there's never more than 8,000.
Exactly.
So Simon asks, do you have any backtests showing how tradable something like this is? So that's actually a great question, because the data here from CERN, we don't yet have this these external sort of data sets integrated in to our backtester yet. That is happening, like, when I get out of this webinar, I'm going to go test that functionality, though. So that gives me a chance to sort of sell that and say, yes, this data will be available in the pipeline API in the coming days and weeks. So get ready for it. We don't yet have it because we didn't have it convenient to us inside the backtester.
And just to add on top of that, CERN actually released a couple of backtests. Actually trading on this data, and you can go, it's on the community page, to search for a CERN, and you're going to see a couple of those trading strategies kind of come up.
So the size of the bounce is that 1%. Yeah, that's I think we covered that. And Simon has an idea. How post-news? Not quite understanding Simon's question. Once again, proving that our community is way smarter than me and Sung.
Come up over and over again.
We'll chew on that. In the meantime, let's throw things over to Kumesh, and he can do a quick walkthrough. Or I will ask him a quick questions, and he can do a walkthrough of the data and how it gets generated. So let's make Kumesh the presenter. Yeah.
You're gonna have a hard time.
So
just ask him now.
Yeah, so Kumesh, we're about to make you the presenter. We'll unmute you there. And I guess what I really want to understand is how you go about gathering the news stories that work into that sort of underpin this data set, and then how you go about the process of assigning sentiments, or just the general, like, what do I need to know to understand, like, how this data is generated. So if I'm going to be using it in an algo or in my research, like, how is it generated, just to get that background.
So I'm about to make you the presenter.
And let's unmute.
Cool. Sounds good, guys. Can you guys see my screen very well? I hope. Okay, so what I'm going to do is walk you guys through how we do the sentiment, the process of how we are actually collecting the articles and extracting the insights from it. So give me a second. Okay. There we go. Okay. So what we do is we basically monitor 20 million news and blog sources. So these news and blog sources, they're basically public information on the web. So whatever public information you can go on, basically you can search on Google and you can find the articles, we have access to that article. So we monitor about 20 million news and blog sources, and we try to extract different types of analytics from these articles. So the first two algorithms that we use is called entity extraction and event detection. So entity extraction, it's basically extracting the tickers and the company names from articles. So if an article says Apple just got into a lawsuit, we're going to be able to extract that company's name, the Apple, from that article and put it in our data set. And for our entity list, we have tons of different variations. So we have about 110,000 different entity variations, and the entity variations is specifically for U.S. Equities. So we currently cover about 8,000 U.S. equities. And so all the different variations we have is, let's say, for Microsoft, Microsoft can be written as Microsoft Corporation or Microsoft Corp or Microsoft with a ticker in the bracket. It's all these types of variations we're able to track in articles and extract them. Aside from entity extraction, we also do event detection. So we're able to detect the event that's mentioned in articles on the web. So we have about 30,000 different event keywords variations which we look for in articles, and we try to extract these information. So the web is massive. They have lots of information. Billions of articles are being posted each day. Every day we're getting in about 5 million raw unstructured articles, and what we need to do is that we need to find out which of these articles are relevant. So that's why we have these two algorithms. So these two algorithms help us determine whether the article is relevant. So is this article talking about a specific company, and is the article is the article talking about a specific event that's related to a specific company? So if an article is talking about a company and also talking about an event that's specific to that company, so let's say Apple got into a lawsuit, we're going to extract this article and tag it as relevant. So it's a relevant article that we're going to conduct analysis on. But before we even do the analysis part, what we have is we set up an entire filtration system to detect for spams. And so the 5 million unstructured data that we're getting in, we first basically tag and check which article is mentioning a specific company related to an event. And then after that, we look for the spams. So the first type of spam that we look for is basically pattern recognition. So there could be spams that says Amazon just got, so there could be articles that says Amazon with a coupon deal. So Amazon coupon deals, you can't really trade on that article. That article is not valuable. So if an article, let's say, mentions a coupon deal, we look for different types of spam that says, let's say, Walmart has a coupon deal, or Best Buy have a coupon deal. So it's these types of articles we're able to recognize using pattern recognition, and we're able to cancel out these articles from our analysis. So we're not going to be analyzing these articles, and you're not going to be trading on these articles. And then we have our proprietary blacklist of spam sources. So we have a bunch of different sources that we detect as spam sources. So these sources are usually releasing spams. They're usually releasing articles that mentions the company, but it doesn't really affect any type of stock price movement. It's just advertisements about a specific company. So it's not really relevant information that a trader would use. And then we have detection for inappropriate slangs and keywords, phrases, and all that. So we do a lot of different spam filters from these articles because the web is, as I mentioned, the web is massive, and it's extremely difficult to actually capture relevant and actionable trading information from the web unless you do a heavy filtration and spam detection. So after we do that, so after we are able to get these relevant articles, now we apply the analytics on top of it. So in Alpha 1, our retail version, we have two different analytics. So one of the analytics that we have is called sentiment analysis, and the sentiment analysis is constructed in a very structured format. So basically, we have three levels of the sentiment analysis. So the first approach that we used is a bag of word approach. So bag of words is basically we have a finance-focused dictionary which contains a lot of different positive and negative keywords, and these negative and positive keywords have different types of weights. So let's say Apple has good. Let's just use a normal phrase. Let's say Apple has a good earning. So good. Let's say it's going to tag as about 0.25, but Apple has great earnings. That's going to be even more positive. So it's the word that's different, that's differently weighed. And so we look in the article bodies and look for these positive and negative keywords, and we basically we basically are able to get a score, an average of that sentiment of the article. So this basically tells us if the article is very positive or very negative towards a specific company. And then after we do this typical bag of word approach, we have n-grams, which is company-specific sentiment, which is basically event-specific sentiment. So stock price steadily declines. Steadily declines, that's a trigram. So this is steadily declines. That's basically very negative in a finance world. But in a marketing world, price steadily declines. That can be good in the marketing world, because if prices of a product is decreasing, that could be a good thing for customers, because they're going to be able to get it cheaper. But since our analysis and our sentiment analysis is finance focused, price steadily declines, that's very negative in the finance world, because that's always usually talking about a stock price. So our entire dictionary is finance focused, and it's meant for traders to use. Then the third analysis that we do for sentiment is deep learning. So we had a bunch of PhD students and professors actually grade a bunch of articles. So we graded about 100,000 different articles, and they graded those articles based on their perception of that article affecting the stock price. So if it says, let's say, Apple just got into $1 million lawsuit, they might grade that as, let's say, a negative 0.5. But if it says Apple got into $1 billion lawsuit, that article is going to be graded more negatively, because it's a much more higher value. And so when these guys grade the articles, we take their entire, we use that as a training set, and we apply it to our future models, and it basically gets updated and trained. And we basically combine all of these three approaches, and we're able to have a very granular sentiment, which retailers, quants, can actually use. And the sentiment, pretty much you can use it as directional triggers. So the sentiment basically tells you whether you should long or short your position. And as Sung mentioned in this case study, there's different ways you can actually use the sentiment. So you can play around with that. So aside from the sentiment, we have impact score. So impact score, it basically lets you know if an article is going to have a more than 1% impact on the stock price at the end of the trading day. So basically what we do is we look back in history and we basically overlay the events data with the stock price data. So let's say Apple got into a lawsuit. Whenever Apple gets into a lawsuit, did this event actually impact or affected the Apple stock price by more than 1% at the end of the trading day? And if it did, we're going to basically count all the instances in that 2 or 3 years of history that we have of how much of every time whenever Apple and lawsuit comes out, how many times did it actually affect Apple stock price to increase by more than 1%? And then we just put them together and do a probability statistic measure, and are able to get a probability score that lets you know if whenever Apple and lawsuit appears, whenever, let's say, Apple gets into a lawsuit, if this is actually going to affect the stock price by more than 1% at the end of the day. And you can basically use impact score to actually filter and trade on critical articles. So you wouldn't want to trade on articles that talks about, I don't know, Best Buy is getting a sales on their MacBook selection right now. You would want to trade an article that's actually very critical and that actually relates to the stock price. So Apple getting into $1 billion lawsuit, or Apple recalling millions of its Macs. These are the articles that's going to have a very high impact score, and you would want to probably filter on these information. And also another thing to mention is that these scores, so the sentiment and the impact, it's specifically to articles. But what we did in the Alpha 1 is actually aggregate all the article sentiment and aggregate it for the day. So the way we aggregate it is basically from 12 a.m. to 11:59 p.m. for let's say October 20th for 12 a.m. to 11:59 p.m. We look at all the articles related to Apple for that specific day, and each article has its own sentiment score. So what we do is we basically aggregate and do an average of all those sentiment score. And once we do the average of that sentiment score, we're going to date it not October 20th, but actually October 21st. And that's the day you're actually going to get the file, and you're going to be able to trade on it as well. So to make a note that the analysis, the date column is actually shifted towards for a day. So when you're doing the trades. And then the same thing goes for the impact score. So all these metrics, all the sentiment and the impact, it's all accumulated for the day itself. I think that would be about it. So I'm going to switch it to Sung and Josh, or if you guys have any questions, feel free to let me know.
Great, thanks a lot. Thanks a lot, Kumesh. I think we have one question here from the crowd specific to Kumesh. How fast can a CERN sort of get the data? I think this is essentially a sort of an opportunity to describe the two different products that you market. There's the one that you market broadly to hedge funds, and then the one that's included inside the Quantopian product.
Right. So so we basically are able to pick up these articles very frequently. So there's a few things I would need to go into now. So for example, we like to say that we're able to pick up information from low traffic blog sites, and these low traffic blog sites. So let's say I'm a blogger and I have 1,000 viewers on my blog site. So if I were to release an information saying Apple just recalled 1 million of its Mac, and let's say I have some inside information, or I have some credible information on Apple, and I post that credible information on my blog site, which have only 1,000 viewers. If I post this information, Google search engine wouldn't pick this information up in a timely manner. They would take like hours or days to actually index my site because of the low traffic usage. Google search engine basically index high viewer sites more frequently. So if Bloomberg were to release an article, they would index that site very frequently. And if you go on Google search engine and try to search for the article that Bloomberg released, you would find it that second. But for my article that I publish, when you go on Google search engine and try to find it, you wouldn't pick that up at that second. You would probably have to wait until a few hours. So as for the frequency, we are able to hit these low traffic blog sites very frequently, faster than Google search engines are able to index it. All the major search engines are able to index it. And we're able to capture these articles and analyze it, process it, apply the analytics, and send it to you very fast. So we have a real-time data feed, which is AlphaStream, which is the hedge fund data feed. And so you're going to be getting that articles in real time. But for Alpha 1, it's pretty much a daily aggregation. But even though there could be time lags in which you can get the information sooner. So we had a few case studies which have days time lag. So we're able to capture these information from low traffic sites before it actually gets exposed to the large medias, and days ahead before it actually gets exposed to the large medias. So you can have some sort of a great time advantage with the analysis from CERN. I hope that answers your question.
Awesome. I think so. One last question. We've got here: does a CERN get data from social websites like Twitter?
So yeah, that's a great question. So currently we don't get social data from Twitter, but we will be implementing that soon. We could have got social data from Twitter sooner, but the reason is we found the majority of the users on Twitter are basically considered secondary source. So a lot of the users on Twitter are actually reading news and blog sites, and they're republishing that link to their followers. And so the blogs and news sites are actually the primary source majority of the time. And there's only a rare percentage of the time that Twitter is actually the primary source itself. So that's why we start off with news and blogs, because it makes more sense, because majority of the time news are going to break based on some guy who has some sort of credible intel. But we will incorporate Twitter down the road.
So I think that is it in terms of the questions. So I want to thank everyone for attending today. I appreciate all the questions and the interest. And we've recorded this, so we will post the recording on our YouTube channel as soon as we get it processed. And we appreciate everyone's attention. Stay tuned, because this is just the first in a series of webinars. We'll be doing further studies with data that you can find there on quantopian.com/data. So click on over to data and check out some of that information, and we'll be doing more webinars in the future. Thanks a lot, everyone.